So almost any real estate purchase has to get financed, though some are done for cash. But in fact, most cash transactions are under contract cash, but there's actually financing behind it. And oftentimes it's either DSCR financing or fix or flip financing. Longtime colleague slash friend, David Mashian, specializes in financing real estate investments. And we had a chance to catch up the other day and thought we'd share information. David, thank you for joining me today.
Always a pleasure talking to you, Bill.
Now, we used to work together in the same office in Westwood for a company, I won't mention their name, but now you live in the state of North Carolina.
That's correct. Yeah, I live in Raleigh.
Raleigh, North Carolina. So talk about a little bit about Raleigh. What's that market like?
The market, I would say it's like a secondary market if you're going to compare it to like cities like LA, New York, stuff like that. It is the capital of North Carolina. It's growing. We're not seeing the recession here or kind of slowdown here as much. It is slowed down compared to the highs, but I think like Texas and Florida and other states are experiencing much more downturns than we are.
Probably more adjustment. I think they grew so quickly, they're giving back some of those excess gains, but they're still higher than they were before. North Carolina's been a little more steady, I think, as far as its growth pattern.
Yeah, we're getting tech jobs here in the triangle of Raleigh, Durham, Chapel Hill, and a lot of industrial jobs in the triad, which is like Winston-Salem, Greensboro area, and Charlotte is a banking center as well. So there's a lot of industries here that are still moving in.
So I've known you for a while. I want to say maybe 10, 15 years or so we were colleagues. Yeah. And at that time you were involved in commercial real estate investments back then, and you had trainings and talks on how to get into investments. It makes sense that you'd focus on the financing because that has the same thing. Let's talk a little bit about financing investments. First off, why did you go to that angle or that approach as your main focus as far as business? Financing as opposed to sales, or financing as opposed to syndication?
I kind of fell into it. One of my friends said you should go into hard money lending, and I took him up on it. And I saw some other colleagues who were mortgage brokers having the option of doing not only sales, but I mean, in brokerage, I did basically sales, but the mortgage brokers did refinance as well as purchase. So I like the idea of being able to, have two angles at any deal and improve my deal flow rather than I was only pure sales. So if sales slow down, that means I got nothing to work on. So that was the reason.
I think one of the big changes, I've been in real estate since 1986. I think a lot of loans that are done now by brokers, fix and flips, DSCR loans we'll talk about, are loans that banks used to do. Banks these days are so consolidated and focused on lending to major corporations that they've abandoned it, and there have been entrepreneurs to fill in the places for deals that otherwise make sense. So let's talk a little bit about the products you focus on. I know one of the biggest products you work on is DSCR. So first, explain what the letters stand for. And second of all, why that product makes so much sense. Why does it make sense to have a loan product there? It sounds hokey that you don't need to have traditional data, but when you think about it, it really does feel a need in the marketplace.
So I pretty much focus only on investment properties, whether it's residential investments, new construction for residential properties, or commercial. So one of the things, there's DSCR commercial as well as DSCR residential investments. They both function the same way. Debt service coverage ratio. DSCR stands for debt service coverage ratio, which means that your rents are able to cover your taxes, insurance, principal, and interest. PITI, principal, interest, taxes, insurance. So when you have, let's say you're making a rent, you're collecting a rent of $1,000, and your principal, interest, taxes, and insurance is also $1,000. That means you have a debt service coverage ratio of 1-to-1, or in the industry, they call it 1.0. So that means there's really no money left over. You're really at a break-even point.
As long as you get all your income, as long as you get all your rent, as long as expenses don't come up.
Yeah. So this is kind of a highly idealistic way of looking at a property. The lenders know that it's not the truth in actuality, because you have maintenance costs, you may have property management, kind of various things that come in the way that's going to cause, you to come out of pocket where the rents aren't going to cover it. But the market's pretty aggressive, and everybody's getting aggressive in terms of going after these kind of loans. So it's a very favorable loan. We don't need tax returns. Not much experience necessary either. If you want to buy a DSCR loan, you can just literally buy one. You don't need to have proven that you are an investor with a lot of experience, and you can buy them across the country.
The most commonly, you mentioned the DSCR ratio of 1.0. Most commonly, these loans are done at 1.15, 1.2, depending on the product, depending on the situation. The rates, of course, make a difference. But really, all they're saying is that the property pays for itself with enough room to spare for us to feel comfortable making a loan, right? It's the property that really is being underwritten, and is the credit worthy at that loan amount or not.
That's right. So to elaborate on the DSCR, which you said 1.15, what that means is, let's say your rent is $1,150 and your principal, interest, taxes, and insurance is at $1,000. So you're $150 over positive cash flow, and that means you got the 1.15. Similarly, you can go negative, where let's say your rents are $800 and your costs are $1,000. So that would mean you're actually negative cash flow at a 0.80 DSCR. And I do loans like that still, even if you're negative cash flow, and it largely depends on the lender and the various circumstances of the loan, but that's even possible on a negative cash flow. So for residential, you see DSCR, you'll get better terms and more favorable ratio, like a 1.0 is typical on residential investments, 1 to 4 units. On commercial, which means multifamily, like 5 units and more, or retail, office, industrial, I can get a DSCR. They're going to have higher ratio requirements. The lowest is probably 1.15, 1.25 to 1.2. It's going to go a higher ratio depending on the risk perception of that asset. So like an apartment will probably have a 1.15 DSCR, while retail may have a 1.3 DSCR, because they perceive retail as having more risk, and office may even have a 1.3 as well. So it all depends.
Basically, every property then becomes financeable if you're willing to put down enough down payment, because at some point, more down payment means less loan for the same income. At some point, that income becomes enough to cover the expenses by a certain margin. So it really is about what loan to value could you finance this property. It's not whether it's financeable or not.
That's exactly right. Yeah, you nailed it. So yeah, so let's say if it doesn't debt service at let's say 75% LTV, it'll debt service, let's say, at 65.
Right.
So that means the borrower has to come in with more of a down payment.
And properties in certain markets like Los Angeles, multifamily traditionally will only finance at 55, 60% loan to value, maybe 65% on certain properties, because traditionally people want to pay, get less income on properties in Southern California because of the appreciation. Other markets, you have to get, you're able to get closer, 80%, 75%, depending on the market, right? So those are geographic changes based on the marketplace.
Yeah, those are geographic specific, and lenders also know that. They're not going to apply the same ratios to a property, let's say, in North Carolina, as they would to LA, because they know that the ratios, it's a different market entirely, and they're going to view it differently. They're going to see it's more appreciation, but that's on the commercial side. On the residential side as well, they'll do it. There's different tolerance, because ultimately these notes get purchased by investors, and they have to fit within a certain buy box that the investors outline a criteria of what the loan criteria has to be. And if it doesn't fit that, then the originator gets stuck with the loan.
I've also seen the DSCR loan used for the final part of a value add, where they buy a property, maybe a multifamily that has very low rents, but can be fixed up, upgraded, raise the rents dramatically. And the investor knows, well, if we can get to this level, and get these higher rents, then it will generate this income and be worthy of a final refinance at these higher at the higher loan to value down the road, or we can recoup some of the investment up front. So what percentage of your business are, like acquisition versus, say, refinance after value add?
Most of the time it's a refinance.
Mm-hmm.
I'm seeing people want to just kind of pull money out to go deploy into other things.
Right.
The acquisition costs are kind of like, as you know, the market right now, prices are still relatively high and the interest rates are high. So there's kind of something has to give here to make things make more sense. And it's just not making much sense right now for a lot of investors.
Typically, do DSCR loans for commercial property or multifamily require personal guarantees, or are they able to be done through an LLC?
They all require personal guarantees. Yeah, if it's a larger, let's say commercial, let's say there's a sponsor, they're going to personal guarantee it, and depending on the ownership structure, if the investors own 20% or more, they're going to be on the hook as well.
Got it. Let's talk a little bit about another product you do are fix and flip loans. What's the most common fix and flip scenario that you finance?
Basically, a fix and flip is a purchase loan plus the rehab. So just to keep the numbers simple, let's say you bought a property for $100,000 and you're going to put 50 into it, and you think it's going to be worth 200. The lender will take the 200 value and they say, okay, we'll lend you a maximum of 70% of the after repair value, which is the 200,000. So 70% of 200 is 140. So if they're in it, they're saying the purchase price is 100,000. The lender typically gives 85% of that purchase price. So that's 85,000 plus another 50. That's 135. So they're within the range of the 140. So that deal will work. If those numbers don't make sense, then it's either not a good deal or we can try a different lender. Now, these ratios do change depending on the borrower's experience and liquidity. So if the borrower has, let's say, they've done 100 fix and flips, they pretty much can get 100% financing across the board.
Got it. Well, it sounds like each of these scenarios, whether it be DSCR financing or fix and flip, are highly unique to the person, the transaction, and the geography. And that's why it's important, I think, to have an experienced originator who's helping you. So talk a little bit about, at what stage do you get involved? Are you getting phone calls? Hey, I'm in escrow. I put my money down, done due diligence. Do you get phone calls when people are shopping to see what they qualify for? How does that work for you in your business?
I get involved in every stage. I come in there as a rescue lender a lot of times, where some other lender dropped the ball and now they don't have much time, and I got to help them finance it. And that includes DSCR. It doesn't even have to be fix and flip. But most of the time it's a relationship I've built with a lot of people, and I get a lot of I get referrals saying, oh, somebody worked with you, or they know about you, and so it's relationship wise, they already know to contact me before they go under contract. I give them a term sheet. I look at the deals to see how financeable it is, so they're not wasting their time. But a lot of times, once I give them a term sheet, we're good to go. And on fix and flips, one of the things I can do is I can finance a deal in 48 hours, which a lot of lenders cannot. Typically, borrowers can't respond that fast, so we end up like the shortest closing I've had is literally we apply on Friday and close the next Friday within 1 week.
Still amazing.
Yeah, so those are phenomenal. Those are fantastic, and that's how you can. What I think is an advantage here for the borrowers that want to come to me is that they can pretty much write an offer that's, you won't say all cash, but because there is a loan, but it's pretty much treated as all cash because the closing is so fast. So if you want to get in a deal that somebody maybe need, time is of the essence. It's like, okay, give me a whatever $30,000 price discount and I can close next Friday. That might be the difference in making that money and not making it because of the loan.
Well, this is a personal business. I think it's really important. And with all technology and all these big major corporations, more and more, the distinguishing factor is the quality of the people we work with. I've known David, like I said, for at least, I want to say at least 10 years. Was it 2010?
Yeah. What is it?
I think it was 9, maybe. So at least 15
Yeah,
years. We've
probably
known each other and
2009.
stayed in touch. At that time, you were a leader in the commercial marketplace and doing a great job then. Today, it's moneymacmortgage.com as the website, moneymacmortgage.com. I'll put that in the description down below. And you can get in touch with him from there. You'll see a little bit about the different products he has available. Again, we talked about the fix and flips. We talked about DCSR, which covers the 2 to 4 units, as well as some of the other products as well. He has a nationwide, and his phone number is on there, 310-903-6907, and David at moneymacmortgage.com. David, always a pleasure to chat with you, and appreciate a chance to stay in touch.
Thanks, Bill. It was always great to talk to you.